In this Patreon requested video, we're going to take a look at a company called OneMain Holdings, ticker symbol OMF. Their stock currently offers a generous dividend yield that's exceeding 9%, and they've never had a distribution cut since going public in 2013. So right away, these two things make this stock pretty appealing, especially for those who love high income. From a performance perspective, they've done pretty well as their share price is up about 121% since going public, without factoring in those dividends being reinvested. So overall, it looks like this holding does have some good potential, so let's take a deeper look into this company and see if it's worthy of consideration for dividend or income investors. To give a general overview, OneMain Holdings is a financial services holding company that engages in consumer finance and insurance businesses. The company originates, underwrites, and services personal loans secured by automobiles, other titled collateral, or unsecured. The company also offers credit cards and insurance products comprising of life, disability, and involuntary unemployment insurance. OneMain operates through a network of approximately 1,400 branch offices in 44 states in the US, as well as through their website. This company was founded 112 years ago back in 1912, and today they have a market cap of over $5 billion US. The company offers two main products. They just recently rolled out their own credit cards, which they have two of. One appears to be one of those credit building cards, specifically for people who have bad or no credit history. Then they just offer a standard credit card, and it looks like both of these were introduced about a year ago. OneMain also offers insurance products to consumers, but this company's bread and butter are loans, specifically personal loans. These are short-term, high-interest loans that people usually take out to cover emergencies or unexpected expenses. According to their website, their loan amounts range from $1,500 to $20,000, and they offer terms between 24 and 60 months. As you can see, they charge really high interest rates between 18 and 36%. To give you an idea of what these personal loans are used for, their website shows what consumers typically do with their money. They can cover anything from automobile purchases, emergencies, debt consolidation, medical expenses, home improvement, weddings, and the list goes on from there. OneMain offers both secured and unsecured loans, with the vast majority of their loans being secured. Secured loans are loans that are covered by some specific form of collateral, usually a large asset like a car or a home, or sometimes cash or stock investments held by the borrower. So if the borrower can't repay the loan, then the lender would take ownership of the pledged asset. Unsecured loans aren't secured by any collateral, and as you can probably imagine, these come with much higher interest rates since they're much riskier to the lender. So in determining if this company is a worthwhile consideration as a dividend investment, we'll take a look at how this company is doing financially and also try to determine the safety of that dividend. For the year 2023, OMF had a dividend payout ratio of 73.66%, which is definitely on the higher side. Even though financial stocks, including banks and insurance companies, always have higher than average payout ratios, 73% is definitely on the higher end of things, even for their industry. Ever since the pandemic, OMF has understandably experienced a couple of difficulties. Between 2017 and 2019, the company experienced a good amount of growth, but then they saw a dip in 2020 because of the pandemic. In the following year, they reported record profit, which was also reflected on their share price. But then in 2022 and 2023, they saw a pretty sizable drop in earnings per share for both years. In their most recent financial results, net income dropped 14.94% from the previous quarter, and it's down 6.25% from this time a year ago. Their originations have been slowing down on new loans, but their receivables are up, which is likely due to charging higher interest on their newer loans that they are issuing. Finally, their loan delinquencies have been continuing to trickle up over the past year. The number of loans in their portfolio that are delinquent by at least 30 days now make up 6.16%, which is the highest in the last 5 quarters. Although if you compare it with Q2 2023, it's not that terrible of an increase. To protect themselves, they have been loading up on cash over on their balance sheet just in case things continue to get worse for them. Let's now take a closer look at that dividend. Unlike other high-yielding financial stocks like business development companies, these consumer loan companies like OneMain, First Cash Holdings aren't required to pay out dividends. So even if the company is doing fantastic and they are making money hand over fist, they can still choose to eliminate the dividend if they believe that the money would be better used elsewhere. So there's usually a couple things I like to look at when I'm looking at a company that isn't required to pay out dividends on top of other financial metrics. First, I usually check the company's website and their latest investor presentation to see if they've published a dividend policy. Some companies will actually go into detail as to how they determine what they'll pay as far as a dividend is concerned. After searching for a while, I couldn't find a dividend policy for OneMain on their website or investor presentation. What I'll do next is listen to their latest earnings call, because sometimes the CEO or the CFO will talk about their dividend policy or just what they anticipate in terms of paying a dividend going forward. Just a few days ago, CEO Douglas Shulman made the following statement. We are committed to our strong regular dividend, which is $1 per share on a quarterly basis and $4 per share annually. Our board will continue to consider raising the dividend, likely when the macro and credit environment is less uncertain. This is a good sign that the dividend is stable, although they aren't sure when they'll be able to grow it again. But they definitely sound more optimistic that they'll be able to grow it rather than have to cut it. As mentioned at the beginning, they have gone the entirety of their history without cutting their dividend, although they didn't start paying a distribution until 2019. Since then, though, they haven't cut it, and as you can see, they were paying some pretty significant special dividends in 2019, 2020, and 2021. Originally paying 25 cents per share, they now pay $1 per share in dividends. The last time they grew their dividend was in February of last year, raising it from 95 cents. So it looks like they have been slowing down a bit in terms of dividend growth, and especially the special dividends. It's actually pretty impressive that this company paid so much in special dividends during the pandemic. Most companies weren't doing this, and some were actually cutting their distributions during this time. But I'm sure all of us are considering the state of the economy when we're looking at a stock like this. People who are typically customers of these kinds of services are usually on hard times. And if the economy gets much worse, then there's no doubt those 36% interest loans are going to have some more defaults. What usually happens is if a loan is delinquent for longer than 30 days, it'll have a negative impact on the borrower's credit. The lender will take the borrower to court, and if a deal can't be worked out, then a lien will be placed on the pledged asset. With unsecured loans, what often happens is this debt will be sold to a collection agency who might attempt to collect on the past due loan. Obviously, if you're a borrower, you don't want to default on these loans as it'll have a serious impact on your ability to get another loan or a mortgage in the future. What's really important during harder economic times is how well the company is at underwriting. Historically, their team has been pretty successful even during recessions and financial crises. Unlike a handful of other financial companies that went bankrupt during the '08 financial crisis, OneMain has continued to weather the storms pretty well. One sign of strength is that they were actually doing some share buybacks last quarter. This usually occurs when a company believes their stock's share price is largely undervalued, and by doing so, it usually results in the stock's share price climbing since there's less stocks available for them. And unlike other types of businesses, this company has an extreme amount of control over the services that they offer. At any time, this company can choose to stop offering unsecured loans if they keep seeing an increase in defaults. They can also tighten or loosen their requirements before lending to consumers, all depending on how they see fit. Plus, issuing loans at higher or lower interest rates is another degree of flexibility that they have. To quote a statement in their latest earnings call, "Right now we're taking a conservative posture because even though all the economic indicators, when you read the papers and turn on CNBC, everyone thinks the economy is doing great. It's not so great for every person in the country, and the less money you have, the tighter it is for you. And so that's why we're running things very conservatively right now. But let me just add, at the very end, we're all booking great businesses, and the businesses that we're booking today we feel really good about. In the end, I think OMF is doing pretty good despite the more challenging environment. Given the nature of their business, I would definitely consider them to be a higher risk company, so anyone interested in making an investment in them, I'd strongly advise against making OMF an overly large part of your portfolio. Going forward, you'll want to monitor the number of delinquencies on their leases to see if this number keeps rising in the quarters ahead. The payout ratio is another metric that you'll want to keep an eye on as well. But considering the fact the dividend is well covered, the board sounds really confident that they want to keep the dividend and they've been saving up cash for a more serious situation. Their stock sounds like it's in a really good place right now. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.